Hey everyone, welcome back to Corporate Decoder, the place where we break down the complex world of corporate finance. And yes, today we'll be diving into Horizon Technology Finance Corporation's latest prospectus supplement buckle, because this one is all about raising money and what that means for your potential investments. And I've got some juicy tidbits straight from the official filing to share with you. Alright, so Horizon Technology Finance Corporation, or HTFC as we might call them, is basically a finance company that lends money to young tech and life science companies. Think of them like a venture capital bank, but for debt. Now, they are out there looking to raise $57.5 million by selling these things called 7.00% notes due in 2028. Let's look at the money side of things. They are offering these notes at a public offering price of 100%. That means for every $1,000 worth of notes you buy, you are paying $1,000 up front. Pretty straightforward. But here is where it gets interesting. They've got this thing called a sales load, which is like a fee for the people selling the notes. In this case, Oppenheimer and Company Incorporated. This sales load is 1.500%. So out of that $1,000 you pay for a note, $15 goes to the seller and $985 goes to Horizon Technology Finance Corporation. So after all those fees, they are expecting to get about $56.6 million from this offering. They say this is before expenses, which they estimate will be around $200,000. So that brings down their net proceeds even further. This money is mostly intended to repay existing debts, especially their 2026 notes, which are coming due soon, and also for general corporate purposes. Now let's talk about these 7.00% notes due in 2028. What does that interest rate mean for you if you buy these? Well, it means that for every $1,000 you lend them, you'll get $70 in interest each year. They plan to pay this interest twice a year, every the 15th of June and the 15th of December, starting in 2026. So you get a steady stream of income. Pretty nice, but remember, it is not guaranteed. Here is a big point about these notes: they are unsecured. That means they are not backed by any specific company assets. If Horizon Technology Finance Corporation were to face financial trouble and go bankrupt, the people holding these unsecured notes would be lower in line to get their money back compared to people holding secured debt. This is a pretty significant risk to consider, and it gets a bit more complicated. These notes are also structurally subordinated to any debt owed by the company's subsidiaries. Essentially, this means that if the company's subsidiaries go under their creditors, get paid first before any money flows up to the parent company to pay off these notes. This adds another layer of risk because the assets of the subsidiaries are not directly available to satisfy the claims of the note holders. Let's peek at their financial health. As of the 30th of September 2025, their net assets attributable to common stock were about $315.7 million. That sounds like a lot, but remember they also have debt. Their total capitalization, which includes debt and equity, was about $294.7 million. Now, this number is before they consider the merger they are planning with another company, Monroe Capital Corporation, MRCC. After the merger, the pro forma total capitalization jumped significantly to almost $447.4 million. This merger is a big deal for them, and it is going to change the company's financial picture quite a bit. And of course, any financial document like this will have a hefty section on potential risks, and there are a lot. They mention the risk of the notes being unsecured and structurally subordinated again. They also warn that the indenture, which is the legal agreement for these notes, has limited protections for bondholders. This means the company has a lot of freedom in how it operates and can take certain actions that might not be great for note holders. Another risk is their ability to redeem these notes early. What this means is that Horizon Technology Finance Corporation can decide to pay back the notes before they are due. If they do this when interest rates are low, you might not be able to reinvest that money to get the same return you were getting from these notes. Then there is the whole change of control thing. If some major event happens like a takeover, they promise to repurchase the notes. But here is the kicker: they admit they might not have enough cash to do that. This is a pretty big warning sign. And because they are a business development company, or BDC, they are allowed to use leverage, meaning they borrow money to invest. While this can boost returns when things go well, it also magnifies losses when things go south. They are quite open about this magnifying effect on risk. Now, a key part of how this company operates is through its advisor, Horizon Technology Finance Management LLC. This advisor basically runs the show, managing their investments and operations. They are led by 4 senior managers, including Michael P. Balkin, their chief executive officer, giving you a sense of the leadership at the helm. A major recent development that impacts their future is the planned merger with Monroe Capital Corporation. They've entered into an agreement for this merger, which is quite complex, involving asset sales and then the actual merger. This is a huge strategic move, and the details are still being worked out. Looking at their capitalization table as of the 30th of September 2025, on an actual basis they had about $759 million in total assets and $443.5 million in liabilities. This means their net assets were around $315.7 million. After the notes offering, they expect their total assets to be around $758.1 million and their liabilities to be around $442.4 million. Their net assets remain pretty much the same at $315.7 million. It seems this offering is mainly about restructuring debt, not a massive expansion of assets at this exact moment. They've got RSM US LLP as their independent registered public accounting firm. This is the company that audits their financial statements, ensuring everything is reported correctly without bias. And finally, like most filings, they incorporate by reference a whole bunch of previous reports. This basically means you need to look at those other documents too to get the full picture. So what is the story with Horizon Technology Finance Corporation? They are a company in the business of lending to innovative but risky tech companies. They are raising money through unsecured notes, which is inherently risky. They highlight these risks themselves quite clearly, including the possibility of not being able to repurchase notes during a change of control event. They are also undergoing a significant merger, which adds another layer of uncertainty and opportunity. It seems like they are trying to manage their debt load and position themselves for future growth through this merger, but it is definitely a high-risk, high-reward scenario. The unsecured nature of these notes and the subordination to subsidiary debt mean investors need to be very aware of the potential downsides. The company is being quite transparent about these risks though, which is a plus. Now, looking at these numbers and the risks involved, it is clear that investing in these notes is not for the faint of heart. The 7% interest is attractive, but the unsecured nature and the complexity of their financial structure, including the upcoming merger, mean you are taking on a fair bit of risk. I'd say the company is heading in a direction of significant change with this merger, but whether that change leads to greater stability or amplifies existing risks remains to be seen. The key opportunity for them is to successfully integrate the merged entity and deploy capital effectively. The main risk is clearly their debt structure and the execution of the merger. Alright, that is our breakdown of Horizon Technology Finance Corporation's prospectus supplement. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. And hey, check out that Discord community linked in the description for more exclusive content and to keep the conversation going. Thanks for watching, and we'll see you next time on Corporate Decoder.